Nicola, thank you very much for speaking earlier at the conference. You revealed this morning that you had 100% of your assets in alternative investments. So obviously you're a big believer in alternatives. I just wondered, do you think there's a place for alternatives in everybody's portfolio?
Yes, I really do think that's the case. And a lot of experts who spend hours looking at asset allocation and risk recommend 20%. So obviously I've got a bit further than that, but then I'm a very experienced investor. I've been doing it for 30 years. But I certainly think people should have 20%. It's quite interesting actually that somebody during the morning session said that some of the big institutions have a lot more, and that's absolutely true. So Wellcome Trust here, and then Harvard and Yale's endowments in the US have more like 70% in alternatives. So they obviously see that there's more money to be made, and I absolutely believe that that is the case.
Absolutely. And for advisors, what obstacles do you see for advisors who want to put their clients into alternatives? Because obviously they have to be thinking about regulation and compliance. Is that something they should be worried about, or are they overly concerned about these things?
Well, we're now approved. What Rockpool, my company, does is we invest in private companies and we get EIS relief, so it's very tax efficient. And we are now approved by over 100 panels, IFA panels. So there certainly are lots of IFA firms who are investing in this area and consider it to be a very good thing for their investors to invest in. But clearly it's higher risk, and in addition to that, you've got the problem of liquidity. It's not like owning BP or Shell. You can't just sell it tomorrow, and you end up being in these things for several years often, and then if somebody's circumstances change and they suddenly need cash, clearly that can be an issue, and that's why people suggest you shouldn't have more than 20% of your overall portfolio. There's no reason why advisors shouldn't participate in this area, and more clearly are.
Thank you. And you mentioned EIS there, and Rockpool obviously are very heavily involved in that space. Do you see that as a big growth area for investors and advisors over the next few years?
Yes, I do, because companies need capital in order to expand, and there's very little capital available. In the old days, people used to float on the USM or AIM or whatever, and that's become a lot harder of late. And so for companies that are looking to raise between 2 and 10 million pounds, which is where Rockpool operates, really we and other people operating in EIS like Octopus and so on are the only option often. So I think it will continue to grow because there's such demand that I think investors will see good opportunities coming through.
And just finally, later on in the conference today, there's going to be a couple of sessions on crowdfunding, and I know you've been involved in that space as well. So I just wanted to get your thoughts really on how you see crowdfunding fitting in to the financial services environment.
Well, I think it's really taking off. It's incredible. I know you've got Cedars, Jeff Lynn from Cedars, talking on one of your panels. I've used Cedars twice this year to raise money for a couple of my businesses, and it's been incredibly successful. First one, the money was raised in 22 hours, and the second one, it was raised in 5 days. So I've been really impressed, and they're very professional, and I think there are quite a few operators now doing various things in crowdfunding, not just equity but also debt. And in the new year I'm launching a debt platform called Money & Co, which is crowdfunding debt for companies from individuals, and so we'll see how that goes.
And do you think that's an area that advisors can be involved in, or is it just something that people find online and do for a little bit of fun?
No, advisors can definitely be involved, and actually institutions can be involved as well. And I think the thing is, there are two aspects to this. First of all, the return on cash, as we all know, is pitiful, so people are looking for yield. And the second thing is that gilts are actually really rather dangerous because of quantitative easing. They're massively overvalued, and I would be very wary of investing in gilts or US Treasuries or any of the traditional fixed income instruments. And even corporate bonds are expensive these days as well. And interest rates could go up sooner than people think, and then you won't see the bond markets for dust. So investing in this type of debt is actually, in my view, a much better way of doing it. The key thing is to diversify your risk. You shouldn't just be putting large amounts of money into one company's debt. If you spread it, I think you can get really good returns, 5.5% after all the costs and bad debts and everything. And I think it's a really interesting area.
That's excellent. Nicola, thank you very much for your thoughts, and we'll see you around for the rest of the day. Thank you.